capacity 6400 units is the manufactured, it presume that it's a 100% capacity. And then the two different capacity they ask, one is 3200 units, so it's assumed it comes to 50% as compared to this, and the other one is a 4800 units, so it comes to 75% of capacity. So this is the situation. Now we'll have to prepare a flexible budget for three different capacity. The amount of information is here. And then here, this is a particular. First, we'll ask the information of 100% capacity. Then it is 75% capacity, and at last it's 50% capacity. So that means we'll have to prepare this flexible budget in this three category. One is first is the informations which are available, that is 100% capacity, and the remaining two that they ask 75% and 100%. Here the manufacturing number of units is 6400 units. Here it is 4800 units. And this is 3200 units. Now this is what all about the basic informations which we need for the preparation of a flexible budget. But now the little bit change in this statement and in this budget format also. Earlier in the previous problem, what we did, we find out all the three costs one by one. Start with the variable, then the semi-variable and fixed. Why we start with the variable? Because the variable was actually changed on the basis of the capacity is changed. So that's why we take it variable first. Then we did the semi-variable second. The semi-variable, the certain amount of expenditure is changed on the basis of variance concern, and the fixed is remain same, that would be added. And in that sense, we find out the semi-variable expenses. And the third part, we find out the fixed cost. Fixed cost is remain same whether any type of capacity has been changed. Here we are going to change a little bit because of we have a sales value, and they ask the profitability change according to the capacity. We'll start this first part, that is on the basis of sales. So what would be the expected sales, and the sales given very clearly that the per unit sales is comes to rupees 40 remains same whether the capacity has been changed. 40 rupees sales price is not going to change. Now 6400 units and 40 rupees per unit, the 6400 units and 40 rupees, it comes to 2,56,000 rupees sales. So in case of the 100% capacity, the sales value it comes to 2,56,000. See the 75% capacity, in case of that, what would be the amount of sales, and that is comes to 1,92,000 rupees sales. 1,92,000 rupees sales in case of 75% capacity, and in case of the 50% capacity, it would be around 1,28,000 rupees your sales. So amount of sales is this. This is your sales value in case of different capacity. Now we will deduct one by one all expenses. We'll start first with variable expenses and variable cost. Now see the question. Which are the variable cost is given in the question. Here in case of the variable expenses, first is fixed cost. If you are going to see the table, in the table first is fixed cost is given, and that fixed cost, as I mentioned in earlier problem also, the fixed cost would be remain same whether the capacity is changed. But variable costs are there, and there are variable costs. Start with the first is power cost. Now see here, power cost is given 1,440 rupees in case of 100% capacity. If they have 100% capacity, their power cost is 1440. Now what would be the cost in case of 50%? Half of this. Because of its 100% and 1,440, in case of its 50%, their variable cost is comes to 720 rupees. And then if you are going to see that the what would be the change in case of 75%? So 1440 into 3 by 4. Why? Because of 75 upon 100, it comes to 3 by 4. So now we'll have to find out the how much amount of cost, and that is comes to around 1080 rupees is cost of power in case of 75% capacity. Moving to the next is the after power cost. Next is repairs. Now repairs expenditures are 1700 rupees. 1700 rupees, it's a repairs cost. According to the changes of 50% capacity, it comes to 850 rupees. 850 rupees, that is a change of 50% capacity. So that means the capacity has been reduced 50%. The repairs expenditures is 850. Then we need to find out what would be the changes in case of 3 by 4th. And it comes to around 1275 rupees expenses if it is 75% capacity. So the repairs is also proportionately changed on the basis of capacity. In short, all the variable expenditures are going to find out in this way. So repairs comes to this way: 1700 for 100%, to 1275 it's in case of 75%, and in case of 50% it would be around 850 rupees. After repairs, now miscellaneous expenses are given, and that is 540. So miscellaneous expenses, and that miscellaneous expenses is 540 rupees. 540 rupees in case of 100% capacity. So half of that for 50% capacity, and that is 270. Now we need to find out the how much amount in case of the 75% capacity, and that is comes to 405 rupees. Yes, it is 405 rupees. It is your expenses of miscellaneous expenses, and that is as per the 75% capacity. These are any more variable expenditures are there? Yes, we have two major variable expenditures. One is a direct material, and the other is a direct material and labor. Now first we'll take it direct material. Now see the table and tell me the direct expenses, direct material expenses. It is 49,280 rupees. So 49,280 rupees is a direct material expenses in case of the full capacity, 100% capacity. Now we'll find out the how much amount of expenditures are incurred in case of the 75% capacity. We need to calculate it for that. So 49,280 into 3 by 4, that amount of the material expenditures comes to 36,960. 36,960 in case of if it is 75% capacity incurred, and in case of 50% it is in half, that is 29,640 rupees. 29,640 rupees direct expenditures, direct material expenditures, sorry, 24,640 rupees expenditures of direct material. Next is labor expenses. See the labor expenses, it is given in the question for 100% capacity, that is 1,02,400. And in case of 1,02,400 rupees at the time of 100% capacity, what would be the expenditures in case of here, that is according to this concern that the 51,200 rupees, that is for 50% capacity. It can be easily identified because we need to directly divide by 2. So 1,02,400 in case of 100% capacity, and the 50% capacity is 51,200. Now we'll have to identify the how much amount of proportionate expenses in case of 75% capacity, and that is 76,800 rupees, that is labor expenses in case of the 75% capacity. This is what all about the changes of variable expenses proportionately on the varied of a different capacity. So we just identified the how much variable expenses are incurred on the basis of 100% capacity. If they reduce their capacity from 75 and 75 to 50, amount of variable expenses are incurred. Just we'll have to make a total of total variable expenses. So total variable cost A, that total variable cost is 1,55,360 in case of 100% capacity, 1,16,520 in case of 75% capacity, and 77,680 in case of the 50% capacity. So this is a total of variable cost, and in case of the total of variable cost A, now we'll move for the next part, that is fixed cost. So in case of the fixed cost, we need to identify which are the fixed costs is available here. The fixed cost, only one fixed cost is available, that is 20,688. We have another fixed cost but not under this banner. So that's why we will write only 20,688 in case of the production capacity of 100%. So if the company have a production capacity 100%, the fixed cost is 20,688. Now what would be the change in case of the capacity has been reduced? Listen, the capacity has been reduced or increased, fixed cost remains same up to a certain period of time, or a level, or a fixed cost remains same only. So in that case, the amount of fixed cost is no change in any capacity defined. So here now the total cost A plus B, it comes to, here the total of A and B, it is around 1,76,048 for 100% capacity. Then the amount of concern with 75% capacity is 1,37,208, and in case of a 50% capacity, it is around 98,368. So this is a total cost in case of all the different varieties. Now after the fixed cost is concerned, we'll find out the gross profit. Gross profit, it comes to amount of sales minus the total variable cost. Total cost is right because of the fixed cost is already added. Total cost 2,56,000 minus 1,76,048. So it comes to 79,952. 79,952. Why it is considered a gross profit? Because of still we have one more overhead expenses. That is last line of the question, that admin, selling and distribution expenses is given, which is fixed. But still one expenditures is remaining to be deducted, and that's why it is concerned the sales minus total cost along with this fixed cost. It's a different fixed cost, but this fixed cost is to be deducted from it, we consider as a part of a gross profit. In case of the 75% capacity, 1,92,000 minus 1,37,208, the calculation it comes to 54,792. This is your gross profit in case of 75% capacity, and in case of a 50% capacity is 29,632. Deduction between 1,28,000 minus 98,368 comes to 29,632. This is a gross profit in case of the changes is occurred so far is concerned of different capacity. Now we have one more expenses, that is admin expense, selling and distribution expense. And admin, selling and distribution expenses are given in the last line, that is 3,600 rupees, and it is remains same in all the different capacity. So 3600 rupees would be written for each capacity and deducted from the gross profit. What would be the concern? Here, in case of 100% capacity, the balance comes to 76,352. In case of the amount of 50%, 75% capacity, it's 51,192. And in case of the 50% capacity, it comes to 26,032. And that is your final answer of net profit. So company earns net profit in case of a different capacity. Here it is 76,352. In case of 75% is 51,192. In case of 50% it is 26,032. If you want to count one more step here, to take a future decision that what amount of profitability has been changed per unit, then also you can calculate it one more thing, that is net profit per unit. And for that, what you have to do it, the amount of profitability has been divided by their concern. Let's see the what amount of profitability you received, you earned in case of the amount of profit per unit is concerned. That is, let's see, let's start with the 76,352 divided by how many units are there? 6400 units. So it is 11.93. Here it comes per unit profit is 11.93. In case of the another manufacturing production, and that is 75% capacity, it's 51,192 divided by 4800 units, and that answer is 10.665. So 10.665 comes to 10 rupees and 67 paisa profit per unit. And in case of a 50% capacity, your profit is 26,032 divided by, this would not be much a change, but let's see, the amount is 8.135. 8.135 comes to 8.40. So this calculation shows that very clearly, if you are working with the 6400 units manufactured, your profitability per unit, it comes to 11.93 highest. But when you are reducing your profit, reducing your capacity, your maybe fixed cost is not compensate your contribution, because of variable expenses are always changed as per the reduction of your capacity. But this cost is remains same whether your capacity is changed or not, and because of this expenditures are remain same whether your capacity has been reduced. This amount of fixed cost not compensated your contribution, and that's why your earning profit per unit has been reduced. Suppose if your profitability is increased tremendously, that maybe capacity per unit reduced may be beneficial, but if you are going to see here, this is not happened in this case, and that's why the beneficial and the decision as per this flexible budget, if I want to take it, I may be going to utilize my full capacity to manufacture the goods with the 6400 and try to reach 6400 units manufacturing to sell it also and earn a profit per unit 11.93. So this is what all about the analysis of flexible budget is concerned. I hope you may be understood how to resolve the problems, how to solve this concern, and how you can helpful to take a decision for managerial aspects for the future efficiency and enhancement in a decision making for the respected task and the respected technique. That is what all about a flexible budget. So moving to the next part of budget, that is related to a cash budget. So moving here, the something new part of budget. Let's see the part of cash budget and cash budget problems, how we can solve out it. Here in the case of a cash budget, instead of the capacity efficiency, we need to identify the how much amount of a liquidity arrangements has to be made by the organizations as per the expenditures are incurred in the business. So that's one is the company need to identify their working capital management. Second, the company identified their revenue generation program, and another thing is they wanted to manage the whole cash inflow and outflow in the business on the basis of their transactions are coming into the business. So for that, we are going to prepare here the cash budget problem. And the cash budget problem, you need to refer the question that is given in the presentation area, and in the presentation area the question number 4, that is Saurashtra Company Limited. So all of you just refer the question number 4 regarding the Saurashtra Company Limited, wishes to arrange overdraft facilities with its bankers from the period of August to October 2010, when it will be a manufacturing mostly for stock. Prepare a cash budget for the above period from the following data given below. So they asked to prepare a cash budget for August to October, that means August, September and October. So they asked to prepare cash budget for 3 months. Here for that we have some information. It's given in the tabulation format, like month. If you are going to see the month, the informations which you are available, almost 7 months, June to December. So that means 7 month informations are given. Sales along according to that 7 months information is given. Purchases is given. Wages, manufacturing expense, office expense and selling expense. So these are the expenditures given regarding the information for the solution of a cash budget. Additional information that is very much important. First is cash on hand is given on 1/8/2010. That means for the 1st August, where we are going to prepare the cash budget for the particular problem. So information of cash on hand is given from the 1st August that we will be using here. Then regarding the sales, then regarding the purchase, and the late payment of manufacturing expenses, that how much, what is the lag period